Welcome back, you legends. I'm Dr. Khan. Let's get right into today's video. Another red day in the markets with all four major indices down big. Leading the declines today was the NASDAQ, followed by the Russell 2000. Interestingly, the S&P 500 held up the best. And that's speaking relatively because it saw major selling today. We had a few pockets of green that I want to talk about. We had healthcare, names like Pfizer, Bristol Myers, and Johnson & Johnson in the green today. We had Google in the green. We had Cisco report earnings and doing well. And of course, we had the energy trade back on the docket today, especially as yields continue to push higher. And as you all know, when yields move up, all commodities, especially oil, likes to follow yields. Let's take a look at the different sectors today. Leading was energy, followed by communication services and basic materials. Lagging today, cyclicals, technology, and industrials. Let's take a look at this chart. I want to start the day with this chart. This is the NASDAQ 100. And I just want to pay very close attention to this. This is a major trend line that basically established this entire cyclical bull rally within the overall market. We are sitting on top of that trend line, just basically, guys, a couple of points away from hitting that trend line. In fact, let's take a look how far we are. We're about half a percentage away from tagging the trend line. Why is this trend line important? Well, because if we break it, all hell is going to break loose. We're talking about no support at all for the NASDAQ 100, all the way down to 13,700. 13,700. No support at all. If we break this trend line, we're going to see significant selling. If you can imagine that, even worse selling. So keep a very close eye on this trend line, because if it breaks, get ready for some serious red. Nothing like this. Imagine all of the stock market map red. No pockets of green, just entirely red. By the way, today felt really painful, even though the S&P was only down 0.8%. We're not talking about 2%, 2.5%, the kind of major selling that we see when we get liquidation breaks and when we get capitulation. This is not the kind of move that you see in a capitulation sell-off. The kind of move that you would typically see in capitulation is something that looks like this, right? Massive sell-off, 7%. Look at that, 7% in a couple of days. From the close to the bottom, that's 4.8%. Can you imagine a 4.8% red day? Now, this is what capitulation looks like. Couple of days down 5%. That's what capitulation looks like. Another example is this. A couple of days, look at that, 8%, just 3 days. That's what capitulation looks like. Another example is this. Single day drop of 4%. That's capitulation. What do we have right now? Well, we had a lot of selling to begin the week, not capitulation kind of selling. Yeah, let's take a look from the top of that green candle all the way to the bottom today. That's 3%. I just showed you days where we had 4%, 5% moves in a single day. We're not there yet, so just be careful. Things could get even worse. With all of that being said, I want to talk about the S&P. Then I want to show you some amazing charts. Really strange things happening. Some really strange, bizarre things happening that I have to show you. But let's just start with the S&P 500 because that's what all of you want to see. So we had a break of the trend support, not trend, it's a short-term support line. It broke yesterday. We had successive selling today. We opened just above it. We broke below it. Back tested it again, failed, continued down. I had calls that I opened at the close of yesterday, and I ended up closing that position entirely at the open. And then we had that back test and continuation of selling. In terms of support, let's take a look. What do we have in terms of support? The key levels, if we drop a range right here, what do you notice, guys? Look at this. We have a top here, another one here, an equal one, and a bottom. Okay, that creates a perfect range between 444 and 431. And if we pay very close attention to what happened the last few days, notice this, guys. A lot of buyers tried to step in and buy it here. They tried again here and they failed. They back tested it. They failed again. And we had that massive break. Okay, so this range is meaningful. It is very important because the market is trading based on this exact range that we're talking about. Okay, so where does the range end? It ends at 431. Now, this is very interesting because maximum pain, okay, maximum pain this week is at 439. And usually, guys, in option expiration weeks, that is the third week of every month, the market likes to close exactly at max pain. That means the middle of the range. If we get another major sell-off tomorrow, we could easily go back to 430, 431, the bottom of the range, and then maybe we could see a rebound. We might not see a rebound. We could simply close below maximum pain. And a close like that would result in a massive spike in volatility and would be really bizarre. It would be out of the ordinary. And to be honest, if we take a look at what happened recently, we were trading within this descending range on the S&P 500, ping-ponging, right? Up and down, up and down, up and down, tagging this support line perfectly each time until we broke it just yesterday. Now, 430 is a huge level because we had this reaction. Tagged it as resistance, came back here, knocked the resistance out, came back tested it. It is now support, and we had that breakout. So what does that mean? Well, if you've been watching the videos, you will know this is what we call a pivot zone, right? A previous resistance, once broken through, it acts as support. And same thing, guys, previous support once broken through, like so, this point right here. Support, once we broke through it, it acted as resistance. That's what we call a pivot zone. These are major price pivot zones. Price loves to pivot around these zones. Once they get knocked out, they switch from resistance to support and vice versa. So we do have support here. It's a major pivot zone at 431. Now, I pointed out yesterday that we had this very clear volume profile. Let me show you what I'm talking about. Here's the fixed range volume profile tool. Look at that. We closed exactly at the point of maximum volume, right? The most amount of volume was traded at 436. And if we look below, there's not many volume shelves other than this shelf right here, and it's at 427. So if we break this pivot zone, you're looking at 427. If it holds, the market likely rallies again to previous support that is now resistance, and that means this level right here, right? Resistance, support, broke through. It is now resistance again. That's 444. Okay, so the most likely price action, guys, based on the volume shelf profile and the pivot zones, is something that looks like this, right? We go back to the pivot zone, back test this, fail, move back down even lower, and break the pivot zone. And at that point, we'll be contesting with this major S&P 500 support line. What does that support line connect? Well, it connects all major bottoms since the October bottom. Where does it sit as of today? Well, as of today, if we drop a vertical line, we're looking at 420.6. What does that mean? Well, there's a very obvious gap here at the S&P 500. Here it is, 422. Okay, between 422 and our pivot zone, we only have one volume shelf profile. That means this entire range could be cleared in 2 days. Day where we go down to 427, another day where we go down to 420 and connect with the support line. Obviously, guys, I'm not talking about any of this happening tomorrow, next week, or anything like that. Again, the most probable course of action for price, just imagine it this way. If you pour liquid, if you pour water in any vessel, it'll take the shape of that vessel. Price action is like water. You're pouring it between major pivot zones. Once it hits a major pivot zone, it likes to flow in the other direction. Once it hits that pivot zone, it likes to flow again in the other direction. And the way they walk the price down is they take out one support level and then they switch that to resistance and then they move down to the next one, right? We had this support level here, 444. It broke down. The next level is 430. That should see some buyers, especially because it's a major pivot zone. It was the major top from the August highs of last year. And funnily enough, we're now in August again. So price will have made no changes at all. If we revisit this pivot zone in August this month, it will mean that price made nothing, no progress at all from August of last year, if you can imagine that. All of these rallies, all of these sell-offs will be completely erased. Okay, so what does that mean? Again, pouring liquid into a mold. The mold looks like this. First, go back down to the pivot zone, potentially find buyers. That really depends on how the market looks like, what kind of structure we form at this pivot zone. But let's imagine we form some hammer candles, some buying comes in, some green candles form. Okay, at that point, we'll say, okay, likely a bounce coming. Where does it stop? It stops at 444. It stops at 444. That will be the 50-day moving average that has begun to curl back down or potentially just flatten. Okay, let's draw that again much more cleanly. Let's draw up a horizontal line right here. Here it is. Tested once, then broke through. Once we got that break, we broke another short-term support line and we got massive selling after that. We're now in the middle of this entire range. The bottom of the range is 431. Again, if we find buyers here, look at a back test of the prior support, now resistance at 444. Once rejected, the 50-day moving average will probably meet price at that point. Reject, continue down. At that point, this support will likely break and will move even further down to test this support line. Now, as I showed you in the first chart, the NASDAQ 100, we're already getting super close to this support line. If the NASDAQ breaks this support line, as you all know, guys, the NASDAQ 100 leads the market. So if it breaks a key trend line, that means the S&P will likely follow. It means that this support line or this major trend line will likely eventually break. Now, let's take a look at volume. Volume has been rising. The candle bars have been getting bigger and bigger. So the selling was more orderly back here. It is now vicious. It is now out of order. It is now, I'd say, fear-driven, algorithmically driven. And that's why we're getting this increasing volume. Again, I haven't seen capitulation volume. Where's the capitulation volume? We're not even above these prior volume bars. We're not even above this one. Okay, so this is not capitulation, not yet. And if we just continue to sell at this point, again, 430, watch how the market reacts at 430. What if price just slices through 430 immediately? What if that just happens? What if we just cut right through it? What happens next? Well, we go down to the trend line, this trend line. It happens to be at this gap fill area, 422. Okay, 422. Now, we have never seen really major sell-offs since the zero DTE, 0-day options. We've never had a big sell-off. So we don't know how the market is going to behave. We've been hearing a lot about Volmageddon, been hearing a lot about Volatilitygeddon, Volgeddon, and what would that look like? Well, that would look like a huge single bar day, massive single bar in a single day that really erases a week or a couple of weeks of price action. I already showed you what capitulation looks like, right? Huge volume. Look at this volume spike. The market ends up capitulating the next day. Again, what does capitulation look like? Let's take a look at this huge sell-off. Look at that. Huge volume. We close at the low of the day, biggest volume bar. We tag major support, in this example, this descending channel. That acts as capitulation. We just get a back test and a rally from that point on. What does capitulation look like in June of last year? Again, massive bar. Look at that, massive bar. Market ends up capitulating just a couple of days later. Just 3 trading sessions later, market capitulates, puts in this hammer candle, or I should say an indecision doji. Indecision dojis, guys, mark the end of a trend. They come at the top. It means the uptrend is over. You see them at the bottom. It means the downtrend is likely over. Okay, so no capitulation volume yet. Let's take a look at January of last year. What does capitulation look like? Massive hammer candle, huge volume, huge volume. This capitulation move happened on Monday. So if for example, we just say the market repeats the exact same pattern, and today is this red bar, tomorrow we'll see more selling, and Monday will open down, sell even more, and then recover at the end of the day. Okay. And if something like that happens, we'll likely tag the trend line, that major trend line at 422 by next Monday. We see just a copy of that, we'll see a tag of the trend line by Monday. There's absolutely no way of knowing whether that's going to happen or not. It's just fun to speculate. Maximum pain is the price point at which the vast majority of both puts and calls expire worthless. Why does that matter? Well, because market makers are net option sellers. They don't buy options, they sell options. And so they make the most amount of money when we hit the maximum pain, especially on OPEX weeks. And this is an OPEX week. The third week of every month is option expiration week. Now, interestingly, max pain has dropped. It is now at 437. It was at 439 yesterday. It was 440 the day before. It is dropping. That could fuel even more selling because obviously those market makers do not want to pay off their option buyers. If you purchased calls, they want your calls to expire worthless. If you bought puts, they want your puts to expire worthless. That's how they make their money. Okay, let's just say we make history. Let's just say we make history tomorrow and Monday. What would that look like? Well, it would mean that we open potentially higher tomorrow, then get another big leg of selling, huge red candle. We close just below 431, meaning we threaten this support. We close below it even by just a half a dollar. That would be read as a threatened level. That would be a threatened level. Okay, if we threaten that level, we could see even more selling by Monday, or something that looks like an open down, a huge sell-off, then a recovery at the end of the day, and we close back at 430. That's all possible. We get a repeat of January 2022. That's basically what happened. We see a more traditional price action. We'll see 430 potentially tagged, but we'll see the market close closer to that 437 level, that max pain level. Okay, so again, that's all assuming the market behaves logically, and we all know the market does not like to behave logically in sell-offs. Now let's take a look at the Dow Jones. I talked about this major support level on the Dow Jones at 342.8. I will probably be in there by tomorrow. That will be a very interesting level. This is a gap that was left. Market will likely fill that gap tomorrow on the Dow Jones, and the Dow has been outperforming the rest of the market recently, led by those energy stocks rising and the rise in oil prices overall. The Dow Jones is also more value heavy, less growth heavy. That means these stocks tend to move less than the rest of the market. They're lower beta stocks, so they tend to move at a fraction of the percentages of the S&P 500. Let's take a look at the Russell 2000, the IWM. It's almost back at the 200-day moving average. We're still trapped in this range. My money time machine smart money flow indicator shows no buy signals, no buy signals yet, just selling in selling. We take a look at the histogram for the PPO. We printed another deep red candle. I don't remember the last time I saw this many consecutive deep red candles. Usually we'll get something like this, right? A bunch of deep red candles followed by pink candles and more, or I should say bars, not candles, bars. And then a switch back to deep red and then pink, right? We usually get a mix. Right? This is an exception. We haven't seen anything like this since, look at that. Look at these red bars. Looks very similar to that break from the November highs of 2021, the end of the bull market. That was the end of the bull market. And we had that liquidation style sell off. And we haven't really seen any of these huge candle bars yet. None so far. We're just getting larger and larger candles. And that could indicate that we're getting even bigger and bigger candles coming in soon. So what happens if you break the 200-day moving average? Well, very likely we fill the gap at this level, 175.5 on the Russell 2000. From this point on, that would mean a 4.5% sell-off. If we break below the 200, that's the most likely outcome. Now, this gap is the same gap that we have here on the S&P 500 on the 1st of June. So if the Russell makes it down there, likely the S&P will do the same and tag this trend line. Okay, let's take a look at the VIX. Again, the VIX is doing something very bizarre. It made a slightly lower high today, even though the market had that massive leg of selling today. Significantly lower low on the S&P 500 versus the low back here. VIX did not make a new high. It made a slightly lower high. So we're still getting that bullish divergence on the VIX. Could that bullish divergence get taken out? Yes, absolutely. It could get taken out. That's a real possibility, especially since we haven't seen that capitulation move yet. So that's possible. We could see the VIX take out that divergence and move even higher. How high can the VIX get? Well, we do have this major trend resistance, and that could mean a VIX that goes up all the way to 25. So these prior highs back here. That would actually make sense. I would imagine when the market bottoms, the VIX will have made it back to these highs. But at that point, we're talking about the S&P down at 422. So that's a bit premature at this point in time. Now the VIX is above the zero line. The PPO for the VIX is above the zero line. We're printing more green bars on the histogram. We did not make a new high today on the VIX. The market will need a substantial sell-off to print a new high on the VIX, especially with a lot of zero-day options being traded. And the traditional VIX looks at options a month out. So it does not look at option premiums for zero-day options. It looks at options that are much further out in time. The volatility index, guys, the VIX is based entirely on the premium, the price premium of both put options and call options, but it's more weighted towards puts. There's a larger weighting towards puts because a lot of put buying is what happens when the market is panicking, and the VIX really tries to capture that panic in something that's scientific and measurable. That's basically what the VIX is. Okay, let's talk about the dollar index. The dollar index likes to move in 3 successive legs. There are plenty of examples of this happening. We're now at the end of the third leg of buying on the dollar. When the dollar tops, that's when gold will bottom, and that's probably when it's time to buy gold. If I take a look at the 10-year yield, again, the 10-year yield is still grinding up higher. Momentum is slightly slowing down. It is testing these prior highs from the October bottom, a 2022 October bottom. When yields topped in 2022, that's when the market actually formed that major bottom in October. We're back at that same level. Now let's take a look at the S&P 500 futures. The ES, if you remember, guys, I talked about this channel yesterday. We were ping-ponging between the highs and the lows of the channel. Then we formed this bear flag and we broke below it, formed another bear flag, broke below it. Potentially now we will form another bear flag. If that happens, we can expect an even lower leg, more selling, more selling. If that happens, we will have to, again, duplicate this exact channel, and we'll probably find support here at 4,300. Look at that. That's not a coincidence, guys. That's not a coincidence. Where is 4,300? Well, it's the gap. It's that gap that I talked about. It's 420 on the SPY. Now, that would be pretty catastrophic, right? Pretty catastrophic if the market goes to 420 within the span of a few days. That would be really catastrophic. A first sign that something like that is going to happen is if the NASDAQ 100 breaks a support line. If that happens, expect really massive selling. Expect the NASDAQ to fill its gap. Expect the S&P to fill its gap. And expect the Russell 2000 to fill its gap. The Russell 2000 would be back at 175. S&P at 422, 421 to 422. And the NASDAQ, the NDX, would be back down to, let's see, this gap at 13,600. We would backtest these prior highs from August of last year. That would also mean the S&P would be below the August highs of last year. What does that look like on the Qs? Let's take a look at the Qs so I can show you. It would mean we move down all the way to this level at 330. Again, backtesting the August highs. If we break the trend line, look at that. We closed right on top of it on the Qs. On the NDQ, the actual index, only 0.5% away from breaking it. Really critical, really critical. Let me extend this trend. Oh, look at that. No way that's a coincidence, right? There's just no way that's a coincidence. What if it breaks? Well, obviously, again, boom, we fill the gap at 332. We're at 358. That would be a leg of selling equal to what we already had from the highs. Just a quick follow-up on consumer discretionary relative to consumer staples. We broke this pennant. That means stocks like Amazon and Tesla will get way weaker, more and more selling. Talked about Tesla, no real support for Tesla until 195. Let me pull up Tesla very quickly to refresh your memory, guys. 195, no support at all till 195. That exact same gap. The Russell on the S&P on the triple Qs, exact same gap. That would mean that Tesla would move down by another 12%. 12% down. Now, another big stock that I want to talk about is NVIDIA. NVIDIA is completely ignoring the sell-off. Look at that. NVIDIA is barely down today. Just $1. NVIDIA was down $1. I mean, if there was any bubble, this would be it. This would be one of the greatest bubbles I've ever witnessed. I mean, buyers are still holding out hope that NVIDIA will hold. And it's holding. So far, it's holding. We have earnings next week on August the 23rd. So not a lot of time left. And the downside is massive. The downside is 30%. 30% to fill that exact same gap and to tag this major support line. That exact same support line that I showed you on the S&P, on the triple Qs. It's the exact same one. And we have that same gap, that huge gap that was left in late May, early June. That would mean NVIDIA goes down to 300. Now, this would require a miss on earnings. Now, NVIDIA guided earnings up last quarter. And so if they miss, or if they guide down next quarter, I would not be surprised at all to see NVIDIA gap down on earnings and just leave this entire massive island and just gap down and sell off. I would not be surprised at all. NVIDIA opens at, let's see, 375 and just continues to sell. I would not be surprised at all if it misses. It oh boy, it needs to deliver. This is going to be the most important earnings report Nvidia has ever released. Let's talk about the NASDAQ summation index down below. This is the summation index. Below that is the summation, or I should say the McClellan oscillator. We're now at extreme oversold readings. Pretty much, guys, every single time the market was at this point, it was in a deep, deep sell-off, and it was actually bottoming. Okay, here's one. Let's take a look. Here's another one. Here's another one. Boom, another one, and there you go, another one, there you go, another one. All coincided with big sell-offs and tradable bottoms. We still have one more day to get deeper into the negatives here below 70, or I should say below negative 70. That's when most of these readings were triggered and the capitulation happened. Look at that. That's when most of that capitulation occurred, and that's below the negative 70. Below negative 70, we're at negative 69.9. 69.9. So we're talking about potentially 1 to 2 really big sell-offs, big red days, and then capitulation. Very likely a couple, 1 to 2, potentially 3 very big red days, and then capitulation. Talk about the summation index for the New York Stock Exchange. Again, oscillator down below, deep, deep, deep in the red. Let's do the same exercise here, guys. Let's do a vertical line. Let's put it here. Do a horizontal line. Do it right here at that same level. Boom, what was happening? The market was bottoming, and it just experienced a huge sell-off. Again, bull market was bottoming. It was just a day before the market bottomed, just a day or 2 days before the market bottomed, as the market was bottoming. And we have to go back. Oh my goodness, how far do we need to go back to see an oversold condition this bad? Maybe this one right here. Capitulation happened the next day. How far back? How far back? We need to go back to the pandemic, to the 2020 pandemic. So this is oversold. So this is as oversold as it gets. And again, I'm just watching that volume. I need to see that volume. We really had these big sell-offs. All bounces are failing. All buyers are extremely afraid. We went from extreme greed to extreme fear. Look at that, extreme fear on market volatility, put to call ratio, back almost to those April lows, to the lows the S&P 500 made back here in April. Put to call ratio is back to these levels. Here it is, fear and greed, the timeline below 50. We're now at 46. We're just, again, 1 to 2 days away from fear. That's when those capitulation moves happen. We need to see negative 4%, 5% in a couple of days, or a single day of 2%, 2.5%, something like that. We need to see very, very negative days where the stock market map, all of the map goes red. That's usually when capitulation takes place. Let's talk about the value line index up top. Look at this huge negative divergence. I've been tracking this divergence for a long while, and this is a massive negative divergence. Now, I actually think we'll get an even bigger divergence. I think we'll get something that looks like this, okay? We'll take out the prior highs, right? We'll make a new high on the S&P, and the value line will not, and that will mark the high for the cycle, and we'll get the recession-led 50% style, 55, 60% crash after that. CPC put to call ratio just moving to the moon. PC put to call ratio continues to rise. No buy signal on either of these. These tend to be slightly lagging. So we'll only get a buy signal after the bottom was already made, about a week after the bottom is made. PLT, long-term treasuries, getting down there, not quite there yet at the level that I'm looking for. I'm looking at 88 to 80, right? Back down to these historic lows, multi-decade lows. That's when long-term treasuries will likely bottom. That's when the 10-year yield will top. And we'll get one final push higher by the S&P after that. And from that point on, the TLT, the long-term treasuries, will begin to outperform the S&P 500. Again, that's when recession-led crashes really begin. Gold bull pennant broken. We're back at the 200-day, broke below it for a couple of days. We're probably going to continue down to fill this gap at 170. Again, guys, no gold buyers, no one buying gold until those yields top, those 10-year yields. They haven't topped yet. They're getting close, not quite there yet. The NASDAQ relative to the S&P broke below the 50, still trending down. The 200-day is very far away. We're looking at a sell-off of 2% in the NASDAQ relative to the S&P. That means if the S&P 500 falls by 2 to 3%, the NASDAQ will fall by an additional 2.3%. That means the S&P falls by 3%, the NASDAQ will fall by 5.3%. So a 2.3% additional decline in the NASDAQ expected within, let's take a look, the window that we're talking about, within 28 days. So within the next 4 weeks, realistically, probably coming in within a couple of weeks, either this week or next week, very likely by next week. And again, to fill this gap, same gap that I showed you everywhere, this exact same gap, look at that, should backtest this trend line. Again, guys, when a trend line breaks, we double the distance. It's one of those tricks that I teach here in the channel, and it works very well. I just showed you what happened on the S&P 500 futures, right? Here it is. We had this clean channel. Here it is. We had the clean channel right here. Once we flagged and broke below it, I said to double the distance. We doubled it, and we closed very close to that doubling of the distance. If we again break below that, add another channel, equal channel, that would mean we go back down here, 4,300, and to fill the gap. Not a coincidence. These are measured. Measured moves are very powerful structures, and they're very useful because they can tell you what to look for. You can generate targets based on them even when you don't have any price discovery. So that's very useful. Right now, we're here at this level, just above this gap from the middle of June. It may hold. We don't know. It may not hold. No idea. We'll have to see what happens tomorrow. Again, the reaction is what's important. We have to see how the market reacts at these key levels. We haven't seen that yet. We need to see the reaction first, and based on the reaction, we can assign probabilities to what is going to happen. In terms of economic events, guys, nothing happening tomorrow, nothing on Friday. Next week is a clean week, nothing next week except for durable goods orders by Thursday, but that's not a big market moving event. So nothing really happening next week. So the market will trade based on the technicals and sentiment, and that's it. No big news next week unless some big news story breaks. Otherwise, we're just trading the technicals. So big warning sign here, testing this trend line. If it breaks, we get another 6% decline in the S&P, in the NASDAQ. 6.8% additional decline in the triple Qs, down to 330. That could happen as early as next week. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.